So with that being said, I'm very pleased to introduce our speakers this evening, Darlene Pasieczny and Tony Fisher. Darlene, class of 01, is an attorney practicing in investor claims against financial professionals, trust and estate litigation, and financial elder abuse. Tony, class of 80, is retired after 10 years as a financial advisor at 2 global wealth management firms with another 25 years of experience in municipal bond markets. And with that, the show is all yours.
And I'll just say we're good pals, even though we are bringing different perspectives about the financial services industry that I think are more aligned than not. And
I've never been sued by your firm.
There you
go. We're in good shape.
I get that question sometimes. Do you know this person? Have you sued them? No. All that being said, again, our purpose here, we've put together a little kind of a broad blurb. We've got a little roadmap of what we'd like to cover. And, I think we started to think about this months ago, doing a program on this topic, and it was really more of a financial education, literacy, things to look out for retirees in particular, and
how to not get ripped off.
Yeah, financial scams and issue spotting. The last 2 weeks have happened, so we're in a particularly volatile moment with the markets and the world. We can't give anyone the magic solution here, but a lot of the principles that we're talking about are going to be really relevant, today, as much as they are in a up market cycle or a normal time period. So that being said, everyone's feelings of concern and fear and worry are validated, but there are strategies and there's a profession meant to mitigate risk, and that's what we'll touch on. We'll try. So our roadmap is to start with a little bit about, why and what to look for in a financial professional. And I think this is really critical. When I started doing this kind of work in securities litigation, I had no background really in securities, and understanding the different types of financial professionals, understanding that you don't need a college degree to become a financial professional. And there's a wide spectrum of what people can and should do and how well they do it. And kind of popping that bubble is a first step. And we'll have Tony talk a little bit more from his experience and a good model of what questions one might ask or what to expect if you are speaking with your current or new financial advisor. We'll touch on a little bit of investment products and strategies to be mindful of, especially in retirement, and practical tips to help protect yourself against increasingly sophisticated financial scams. And that's where I'm happy and sad to share some examples, real life examples of very smart, sophisticated people, and the kinds of things that we're seeing that put people in high stress positions and make them susceptible to scams. And again, time at the end for some questions. Our disclaimer is we can't give financial advice to anyone in particular for particular advising on this. Well, I certainly can't. Tony carried a license to do it at times in the past, but
I don't work for anybody, so I'm happy to bloviate as much as the group is willing to listen.
And that makes a difference.
So we'll get started with financial advisors and letters after a person's name. So, Tony.
Yes.
I'll have it start with that. So I got a certificate from John Oliver online that called me a financial advisor. Does that sound about right?
No. No. Why don't I jump in before this deteriorates any further? So I'm Tony Fisher. I started in '74, and wound up leaving in December of '79. And I was a managing director at UBS and before at Merrill Lynch in municipal finance. And after 25 years of a really pretty good career, I thought I would retire and become a financial advisor. And little did I know that actually being a financial advisor was, in many respects, particularly emotionally more difficult for a person of my nature than being an investment banker working for cities and counties and so on and so forth. But basically, when one becomes a financial advisor at a big firm, which is what I did, I went from being in the investment banking side of UBS to being a baby broker. And I went through about 2 months of training and then 2 weeks of sales training in New York. And then I took a Series 7 examination and a Series 63 examination. And I already was a municipal securities principal. None of those things were difficult. In fact, most of them offered remarkably little training in actually guiding clients like yourselves in solving their long-term financial situations, which is kind of strange. But the basic thrust of most asset management or wealth management firms is to get people in, train them on up, and have them go gather assets. And then there are facilities inside of the firm to help them figure out how to actually invest those assets. But mostly the thrust of firms starts out with, you got to get the money in the door, for better, for worse. And that being said, as a backdrop, what I thought I would offer is my perspective of what I would be looking for, particularly if I was retired or nearing retirement, in a financial advisor. And I offer these observations with all humility because I come from one particular background, which is, UBS, one of the world's largest financial services firm, Morgan Stanley, ditto. And I have never served within a small registered investment advisory firm or regional firm or anything like that. And there's no reason not to have a great deal of respect for the individuals in those firms. But there are significant differences in the environments in which advisors operate within those firms. So I thought what might be most useful to those of you on the call is just to, in a perfect world, here's what I'd be looking for.
Before we do that, though, I think I want to go over a little bit what you just said. You mentioned licenses, you mentioned different types of firms. So very broad brush overview of what this is. So Series 7's license, SEC Series 7 is the license to sell securities. So your broker, your associated person with a broker dealer firm who can sell securities gets their Series 7. And there's a bunch of other series and different compliance and supervision licenses and things like that. But that's kind of the basic. The series, you say 63 or 65? One of those. One of those in the
Allstate.
The Allstate
Advisory.
So so different terminology: brokers and investment advisors, registered investment advisors. Brokers we have a dual registration and licensing system in this country between the states and the feds. The SEC regulates and licenses registered investment advisors. So your Series 63, 65 license gives you the authority to give investment advice, basically. The states are in charge of investment advisory firms that have assets under management less than $100 million. So those are small firms in our regulatory structure. And the SEC is supposed to be doing audits and investigations and regulation of the big firms above $100 million. Brokerage firms are license regulated by a self-regulatory organization under the SEC, and that is the acronym FINRA. You may have seen this, FINRA. FINRA.org has a lot of investor information. FINRA.org is also where you can look up the name of a financial professional through its broker check, BROKERCHECK. You can also just search online broker check. And you can find information, public disclosure information, and whether someone is an investment advisor, a broker, or maybe both, because you can wear two hats.
So let me jump in. So, yeah, I know this is dry.
Oh,
That was probably the guy from Paoli. I grew up in Narberth, so I see you. Which is a little town just down the main line. So what I'd be looking for is, these are my prepared remarks, a large regional or national wealth management firm. And I'll explain why. But my sort of big five are a large regional national firm, an advisor, or if there's a team of advisors that I'm considering, the senior advisor has 15 to 20 years tenure in the industry. And I want those people to be, prefer to be compensated on a fee basis, the fee assessed upon the amount of assets under active management. Okay. That puts me into the registered investment advisory regulatory bucket. But for a guy like me, what it means is I don't get paid to execute transactions. I get paid overall to manage your portfolios. So I can, if I have discretion, which I suggest that you find advisors or have advisors who can use discretion, if you trust them, it means that they don't have to call you the way your broker has to do if they are operating on a commission basis. So that's sort of old school people who grew up in the industry in the 60s, 70s, and 80s were accustomed to having to call up a client, pitch them a stock, they get a yes, they get a commission for the stock. It may be 1 or 2% of the amount of the transaction that they just happily inked, and then they go on their merry way. Fee-based approach has a whole lot of reasons why it is, in my opinion, better. I'd like to see folks be with a firm that gives them, because it's large, access to a broad range of asset managers and alternative asset managers. What do I mean by that? Stuff you probably heard of: private equity, private credit. It's very popular nowadays. Hedge funds, other stuff like that. Usually for higher net worth individuals, but you might be surprised that, in fact, if you've got $800–900 million, 100,000 could be productively parked in that venue. And it's nice if you are with a big firm, for reasons I'll explain, that they're able to offer you a broad range of asset managers of both kinds. Then I'd like you to have a financial advisor who has internally within their firm, and that's why I emphasize a large or regional firm, your advisor has access to a whole team of specialists internally who can help them advise you on more complex matters, such as tax strategies, trusts and estate strategies, insurance strategies, yada, 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 yada. When I was at both firms, I took a lot of advantage of having those kinds of resources, because you can't know everything, and there's a great deal to know to properly do the job. And lastly, I'd be looking for a firm that has the ability to offer different kinds of funding solutions to me. They've got all my money. What the hell? Why don't they help out also by having the means of lending me money so that I don't have to necessarily liquidate securities to achieve objectives? Well, and maybe they offer mortgages, and if I'm a small business owner, they may be able to offer preferential lending for me in that. So those are the sort of the big five in my book. But basically, I'd like to be with a firm that offers access to best of breed, as we like to say, products and services, really in all domains. So why a big firm? Well, large firms, first of all, have very large and very invasive compliance operations. I can tell you firsthand, not that I've ever gotten in trouble, but every email that's sent on out from an advisor to a client in a large firm is monitored. Anything I send a client is monitored. There are things I cannot send a client, and on and on and on. And the risk manager is down the hall, and he or she is there to help me and help you and help the firm by keeping funny stuff from happening. Not so much the case in small firms. Small firms, registered investment advisors are often maybe 1 to 5 people. They pretty much run their own little company. And everything, if you've ever logged on to something like E-Trade, everything that you see on your screen, all of that comes from somebody that is not the registered investment advisor. They're purchasing all of those services with a clearing broker. And the names you might hear are Charles Schwab or LPL Financial or Pershing. There are a number of others. But basically, the typical registered investment advisor contracts with the clearing firm, and they do everything. They prepare the statements, the 1099s that get mailed out for tax purposes. They're supposed to compute the required minimum distributions from IRAs. We're all getting near or in those years of our life when we have to take those things, and on and on and on. So they are really critical to the ability of a RIA firm, also sometimes called independents, to allow you to, as an advisor, do what you really want to do, which is talk to clients and manage money for them. Here's the problem. The RIA firm is actually also contracting with the clearing firm to be their compliance department. And as you might expect, they're not particularly interested in having really tight compliance most of the time for most of the advisors. And the firm that's providing it is not interested in spending a great deal of time on that function either. It's kind of like, what do we have to do that's enough? Cool, that's what we'll do. Whereas in a big firm really gives a damn about its reputation. And if somebody screws up, we used to have compliance officers from New York coming in all the time, and they would put up on the screen headlines in the Wall Street Journal or the Financial Times of London, or, you name it, of bad things that had happened to the firm's clients because of some bad actors. Or maybe it wasn't bad actors. It was just people get very, very sophisticated in cooking up scams. So when you're in that kind of environment, you're both, watched over, but looked out for as well. So that's one benefit of being with someplace big that has those functions in-house.
And a customer will never speak with the clearing firm in an independent relationship. I mean, you could try to call up and get to customer service and be put on hold and try to get copies of your account statements from Pershing, but you're not going to have anyone from the clearing firm reach out to you with a, hey, we noticed something funny is happening in your account. That's not their job. They're contracted with the advisor. And the advisor sets the perimeters for what the clearing firm looks for. So I've seen the contractual agreements as to what generates an exception report of, hey, you hit a threshold of this, and a warning goes off automatically to the advisor. And it's the advisor who sets those limits. So the opportunity for lax compliance and supervision is very high.
This is very interesting to me because I never had the opportunity to do that.
Mm-hmm. And one of the great reasons why you have an onerous compliance department is to catch sales of products that are not on the firm's approved list. So selling away of products that are not vetted, due diligence has been done. These are private, separate transactions that maybe this individual human is benefiting from, and it looks like it's approved by Morgan Stanley, maybe, but it's not. And that's a problem.
So let me tee off of that, because another great thing about being with a big firm is besides the fact from the client standpoint that they have reputational risk, and deep pockets, very deep pockets.
That's good.
They have big research organizations which give their advisory teams, oh my God, research on thousands of companies. But more importantly, at a big firm, if I'm a mutual fund company, I can't offer my products until I not only get through the door to the research department that analyzes providers such as myself. I have to have permit those that research department internal to the large firm to come to my office, and they interview my people and they talk to my accounting folks, and they look at everything. And when I was at both of the firms I was at, they would have internal research firms looking to vet asset managers that we would put on our platform and alternative asset managers. And they range between 100 to 200 professionals. And all they did was go around the country and do initial due diligence and then continuing due diligence to make sure that we weren't going to be selling our clients something that was being cooked up by people who, we didn't know, and we didn't know what their investment process was. Because if something goes wrong, the first thing that's going to happen is somebody would say, well, Morgan Stanley, why did you think it was appropriate to offer through your advisors this POS that it turned out to be? So that's really nice as an advisor to know that, there have been people who know a hell of a lot more about this stuff than I do, vetting everything that gets onto the platform that I'm able to show you. Let me jet ahead. I'm taking too much time, but why a team of advisors? Two heads are better than one. And in addition to that, 15 to 20 years means a senior advisor has lived through, I don't know, bad things like the great financial crisis. And they know how they respond to market turmoil. They know how customers, clients respond to market turmoil. It's not their first time through the particular rodeo that may, roll on up. Granted, nobody has exactly experienced what we're experiencing right now with Madman in the Oval Office, but that's one of the real benefits of having somebody who has tenure. You also know that they're actually really committed to what they do if they've been doing it for 15 to 20 years. They've seen what works, they've seen what doesn't work, they have scars on their backs and backsides to prove it, and so on and so forth. Sort of to that point, many of the smaller firms, I'm sort of losing my place here. Pardon me, I flipped one too many pages.
I'm going to make a pitch for why another advantage, and I think we're going to have also a little now of the alternatives, because a lot of these big firms require a certain amount of assets, 5 million, 3 million, before they'll take you as a client. So these are Cadillac, you have the money to spend to afford a host of services that can help coordinate what can be done in careful kind of coordination on your own of separate tax advisor, separate financial planner could be separate, the state attorney, but there is a value to you're paying for the service of the in-house shop that is better coordinated, more likely. But also for fee-based accounts, I want to make the point too.
That's where I was going.
Of, and here's my cases where it's a broker only who, professes to be caring so much for their clients and et cetera, and such a great relationship. But then when something happens, is the first to say, well, I don't have any duty to actively manage your account. I don't have to make recommendations to you. You need to come to me. And a fee-based advisor who you are paying to actively monitor that account and potentially with discretion to take action in the moment, they do have those duties and responsibilities. And it's a much harder argument for me to make if it's a commission-based broker, the market's tanking, and my client is saying, well, why didn't they call me and tell me to do this?
Yeah.
There's hurdles there to that argument. Someone you're paying 1%, 1.5, 2% to actively manage, much better case for, yeah, you should have been calling your customers and earning that fee in that manner.
That's absolutely right. To give you a little feel for what it's like sitting in the chair, when you're a fee-based advisor, as opposed to commission-based advisor, and I know, again, people who are extremely good in the business. They tend to be in their 70s and 80s. No offense to some of you who are maybe on the call. But I hated having to pick up the phone on a commission basis and say, we bought X. It's really not working very well. I really think we ought to sell it. Here's why. Oh, and by the way, the good news is I get paid. Even though you're taking a loss, I'm still getting paid. I'm sorry about that. But, that's just how it works. When you have a fee-based advisor who's operating with discretion, meaning you have conveyed authority to that individual to buy and sell securities on your behalf, let me back up. To survive as a financial advisor, you really, over the long haul, need to have at least 100 households that you work with. And every household probably has anywhere from at least 2 to maybe 8, 10 accounts. So you can imagine how difficult it is to manage hundreds and hundreds of accounts, portfolios, if you don't have discretion. And there's also really cool software that exists for folks who are in a fee-based setting, which allows them to basically take an account and put it into a model portfolio, and then they can tweak that model and and they can select 20 different accounts, and with that push of a button, changes will be made in 20 different accounts. So it's very efficient, but it means that advisor can do more for more people than the person who has to pick up the phone. And it also means that they have a greater incentive to let's get this right. If, we went into, XYZ mutual fund and it is not working out the way we had hoped for, I'm out of there. I'll find something else. Or if the market is getting really fluky, I may feel like, we talked about a risk band. I want to dial back the risk, or I want to dial up the risk. All those things are possible when you operate in that environment. So the other nice thing is, as we've heard so much in advertising on TV for one firm, which is my namesake firm, but I have absolutely nothing to do with it, Fisher Investments. It's nice to know that we do better when our clients do better. And if your advisor doesn't feel that way, then there's something wrong with that relationship. But it really does make sense. And as we talked about earlier, in the fee-based setting, which I really encourage, not for everything, if somebody wants to buy a municipal bond, I always like to say, you date stocks, you marry bonds. It's perfectly fine to get a commission for selling somebody a bond that they're looking to hold for 10, 15, 20 years. Why pay a fee on that for 20 years when, paying once up front does the trick? So in my business, that's what I would do. I'd make some exceptions here and there, but that's where I think it makes sense. But the most important thing is I'm a fiduciary. In that setting, I have to do what is in my client's best interests. When I am acting as a broker-dealer and operating on a commission basis, all I have to worry about, do I know my customer? Well, yeah, pretty much. And is it suitable? Well, I think so. But, you
Well, it's a
know,
little better now. We had some
Yeah.
changes. But I
So
do want to speak about that because that's a huge difference with,
what if I
Um,
skate through the rest of this?
Well,
you-
and I want Darlene to talk about what
This is
is.
my wife,
a
Stephanie
fiduciary. Hi, you guys.
Who's a FINRA arbitrator? We've got it all here, you know?
I'm a vendor arbitrator, but I never get picked because I represent.
Right, but if you could talk to people about what is a fiduciary.
Yeah, so that's the thing too. So and I'm gonna talk about what I look for when I'm reviewing an account that might be problematic as to those signs, the warning signs, the red flags. But one of the first things that I do is look up the human being and look up the firm. What licenses does this person have and what types of accounts are at issue? And a person can have different accounts for different purposes. And that's a huge thing to remember. So it could be that, and now there's a requirement under some heightened duties for even brokers, to consider reasonable alternatives and to consider the type of account for a particular investment strategy. If you've got a money market account that is sitting there, literally cash, earning it like not bad right now, but sitting there in cash, and there's a person charging you 1% for the privilege of having cash sitting there, that's a problem.
Yeah.
That is a violation of responsibilities.
Yeah, and in the fee-based platforms I'm familiar with, there are sort of items which are visible in an account
Mhm.
that are below the line, meaning the fee applies to stuff above the line.
Yeah.
But things like money market mutual funds
Mhm.
and various kinds of short-term investments
Yeah.
or a long-term bond
Mhm.
that may have been transferred in from
Yeah,
another.
you could have a cash component, that's the sweep account, but I'm talking about a this
Yeah,
is the
no.
purpose for this particular account to buy some stuff and hold it and not touch it. That doesn't make sense for a fee-based account. That might be appropriate as a commission-based account. And in fact, we talk about like the incentives, the fee-based, your incentive is to do well for your client, doesn't matter how many trades you do. Commission incentive, you get paid when trades are done, buying and selling. So jump ahead, one of the things I look for is the frequency of transactions in an account and the type of account, and does it make sense? And what's the cost to the customer every time a trade is made? The customer's paying the broker, and that's reducing the value of that account by what's called a churning type claim, just churning this account to generate fees. Similarly, reverse churning, an account that is fee-based, that's sitting there doing nothing. What
Right.
reason for that?
Right.
Yeah.
Okay.
So think about that too, as your types of accounts for different purposes. What might
And
be
you'll
appropriate.
find that, well, you may or may not, and hopefully you won't, but some advisors are like, would get the question, hey, why am I paying you 1%? And my account's the same. You haven't bought or sold anything in, I don't know, a year or 2 years. And the stock answer is, I'm stopping you from doing stupid stuff. Okay? That's what you're paying for. And, we talk about other things like how should I finance my car? And we used to say, I want you to consider me as your chief financial officer. I don't want you to do anything without talking to me because after all, that's what you're paying me for. Well, okay,
Yeah.
that's fine, but I don't buy it. But one thing I do want to make sure I cover is, and this is again, not a knock, but what I have seen when I've been asked to look over the shoulder of folks' investment situations and with a registered investment advisory firm is, remember I talked about things like private placements, private credit, so forth. And I talked about having access to best of breed, say mutual funds or even exchange traded funds. Well, it turns out that a lot of smaller firms hook up with not clearing firms, but financial product firms that say, look, we think we have a really good platform of mutual funds, a really nice array of mutual funds. And here's how we basically manage. This is what we're looking to do, what we think we're good at. And that's what the RIA decides to go with. So just to pick a name out of the hat, you find out that all of the clients' mutual funds are with Dunham. And I've never heard of Dunham before. They're pretty good. But the thing is that no mutual fund company is 4 or 5 stars on Morningstar or, Lipper or whatever, all the way across the board. They may be great in their bond funds. They may be great international equity managers. They may be great small cap managers. They may be mediocre, in other parts of the chart of different segments of the investment world. So one has to ask of those kinds of, in those operations, well, like, can I invest in, dozens of different fund families products? Or am I kind of stuck with the guys that you work with? Because the guys that they work with don't just offer them financial products. They have all sorts of analytical software, which makes it look really pretty slick. Like, we feed in your risk tolerances and your investment time horizons and so forth. And I come up with a really nice looking package that shows you, well, this is how we're going to allocate your assets. And it's really analytically very, very sound.
I would love, as we're wrapping up in time, I would love to hear some from Darlene about the aspect of this talk about protecting yourself against financial scams and some of that element of protection that we had talked about covering tonight.
And I appreciate that. I'm just going to say one other thing because I saw the question on the screen. It's an excellent one, which is fees. I've seen as low as 30 basis points per year, 0.3% for things like at Fidelity or E-Trade. Most full service firms are looking, depending on the size of the account, between say 80 or 90 basis
What's
points.
a basis point?
Basis point is 1/100%. So 0.8% to 1.25%. There, I'm done. Sorry.
Well, okay, of course we could talk for hours on these things, on these topics. But and I think the question was posed, but I want to go back to the human. How do you research now that we've scared you about the different hats people wear and where they worked and how long they have and licenses? So broker check. And I think I can see Matt put this up on the chat. Thank you, Matt, for the link. So that is the link to FINRA's broker check site. That is the only real clearinghouse for publicly available information about a broker or registered investment advisor. There's mandatory disclosures that those people have to make and the firms have to make. Grain of salt, it does not show everything, but and you can research by looking at what's called the Form U4. That's what the advisor or the financial professional has to fill out, or the firm fills out. You can see the questions that are asked and the limitations. Things like bankruptcies are supposed to be reported, things like customer complaints within certain time periods, whether or not it actually escalates into an arbitration or a court case. If there's a settlement of a customer complaint claim with certain dollar amount thresholds, then that'll be reported. The year that the person got their license, what licenses they have, where they worked, the employment history. So again, going back to if I'm looking at a potential case, I'm looking at the human, I'm looking at the firm, I'm looking at the employment history. Oh, this person moved every 2 years to different firms, and these firms no longer exist, and they all happen to be in Long Island. No offense to Long Island, but they had a lot of bad investment firms for a period of time. That's a red flag. Oh, this person had 10 years here and 20 years here at these big reputable institutions that they're going to have training and compliance and go through these ranks. That matters. That's not to say someone is necessarily a bad actor in the first part, but that's a piece of information I want to know as potentially, before I hand over my life savings to this person. I'm also looking at the firm, and you could do the similar kind of research on broker check. You can actually dive a little deeper on the SEC's website, on the Edgar system, and look up financing and registration statements for firms and see how much cash on hand they're reporting in a reporting year. Places that have, I don't know, $10,000 cash on hand. Maybe I don't want to have my business go to that firm. Places that have a healthy margin and, it's not a detailed audit that you'll see, but you'll get a better snapshot, especially for these smaller firms. Not to knock on the smaller firms entirely. So again, talking about big firms, all good things, but they're expensive, or they can be. And you can have a high threshold of assets, minimum amount of assets, just get your foot in the door with the larger firms. Look, considering working with a financial professional, I think it's always a grain of salt. Are they a broker only? Is it a one-person shop that they operate out of their bedroom, in their spare bedroom in their house? Do they have employees? Are there other folks working in that office? These are all types of things that you'll see through that broker check system and looking at the firm. You should know, Oregon is the only state in the entire country that requires state level, meaning assets under management under $100 million, investment advisor firms to carry errors and omissions insurance. No other state requires that. And right now, Oregon only enforces it against investment advisory firms, not against brokerage only firms for reasons of federal preemption. It's interesting to me, but boring to everyone else. But that's scary. So you go with a shop that has 10 grand in cash on hand and no insurance, that's a risk. You have to take that into consideration. Again, part of what I look at is whether it's intentional or it's negligence. If someone screws up and causes money to be lost in your account that's potentially recoverable, I could get a arbitration award, a court judgment that's worth zero if there's no money to collect. And it also can say something about just business sense. Who operates without carrying errors and omissions insurance with that much risk and responsibility? So researching the firms, also researching the acronyms after someone's name. I just want to make the quick point. Again, you can research this on FINRA. FINRA's website, Investor Education, has a whole section on credentials. And as of today, it lists by alphabetical, there's 253 different credentials that FINRA lists. I did not look through the entirety, but I can tell you that I only really put any stock in two of them. One is the CFA Chartered Financial Analyst designation, and the other is the CFP certification, Certified Financial Planner. You can look up independent websites. These are private and credentialing organizations requiring a lot of education, pretty tough tests, and have their own code of ethics. I sit on the Disciplinary and Ethics Commission for the CFP board, so I hear cases that are brought against CFP professionals for violation of the ethical rules. And even if you have a broker who does not have, I'll go back to the fiduciary duty question and what are the responsibilities. A broker who is a CFP professional has voluntarily agreed to be a fiduciary by virtue of having the CFP designation. That's the ethical code. So how do you tell if your person has a fiduciary responsibility to you? You could look up things like that, the CFP code. So that's CFP, CFA, Chartered Financial Analyst. You can look up these acronyms on FINRA's website. If you see your person has this weird C32782 designation, look it up and research that a little bit. But on a basic level, registered investment advisors, RIAs, who are licensed by the SEC, have a federal fiduciary standard. A fiduciary duty is imposed by the Investment Advisors Act of 1940. Brokers do not have such a thing. So broker onlys who are licensed to sell, except state by state, some states will impose a common law fiduciary responsibility. Oregon has a pretty strong history of case law on this topic, but there's no baseline level of fiduciary duty like a registered investment advisor. So brokers now have a duty, it's regulation best interest. It's like a heightened suitability, kind of, sort of. Basically some increased disclosure obligations. They're supposed to tell you how they charge their fees. They're supposed to tell you about conflicts of interest. There's now a requirement called a Form CRS. It's the Customer Relationship Survey, no, Summary. Form CRS that brokers have to give to their customers that gives a summary of certain disclosure information in supposedly easy to read format. Usually it hyperlinks to other complicated documents. But at a minimum, like you should be able to ask these questions of your person and they should give you answers. And if you don't understand them and they can't explain it to you, that might be a red flag also.
Would it be useful if I sort of said what I think an introductory meeting should go like?
Yeah, let's do that.
Real quick.
We'll do that. That's great because that will help me talk about what should not happen. And then I'll run through products and scams and bad things like that I see currently. What I think we can also tailor this a little bit towards folks in retirement age periods who are typically relying on income producing investments, fixed income, probably not wanting to take a whole lot of risk, but may have some clear goals and desires and may be willing to take on risk. So let's talk about that initial meeting of what it should look like when you meet with your financial professional.
Yeah. So here are the intangibles that I think you want to come away with from your first meeting. You want to figure out if the people are smart. You want to figure out if you like them. You want to see if they feel a little bit slick. Slick never worked very much for me, but I certainly saw plenty of advisors who thought slick sold. You want them to ask good questions of you. You want to figure out, do they have plenty of gas in the tank? Meaning, are they sort of the end of their careers, like me? Or, are they going to be with you, for the next decade or two? Do they have assistants who work for them that you like? Because people wind up needing a lot of things from their financial advisory team. And a lot of it is simple stuff like, could you cut a check or send a wire or do this or do that? Can you get a message into, the boss, ask him about X and see when I can hear back? That most firms call those customer service associates. They're specially registered. They're very special people. You want to get a good feeling about them. And if the firm doesn't have one of those, then you should be asking why. How often do they want to meet with you? You should expect to, be offered that they'll meet with you quarterly or even more frequently when you're just getting started out. Most importantly, you want to get a sense of, do I trust this person? Because what we always used to tout was, look, we want to be your trusted advisor. And we really meant. I had a branch manager during the financial crisis everybody was down in the office. I mean, there were a lot of long faces. And he said, look, you people right now are as important to your clients as their doctor, their lawyer, or their accountant, or maybe more so. So somehow you want to try and get a feel like, do these folks really get off on giving good advice to families? How do you get into that? Well, you want to ideally have them ask you a bunch of open-ended questions that, and they may say, hey, before you come on in, why don't you send us your statements so that we can see where you are? And you want them to ask you a lot of questions about you, your financial objectives, what experiences you've had as an investor in the past, what you liked, what you didn't like, what scared you, what, turns you on. Some of us like risk, different kinds of risk. They ought to know that about you. And they ought to say, this is all great before we really come on with any overall recommendation. What we want to do is sit down and run a financial plan for you using our software. Now, everybody pretty much uses the same software in the industry. They rebadge it, firm to firm, but it's basically one amazing piece of software. And they shouldn't charge you for it, because how can they render advice if they don't know what's going to happen to your financial plan and objectives under different market scenarios? Sit down with you, show you what this, series of scenario analysis results in, and get your reaction to it. And, are you freaked out by this? Or are you like, oh, that's no problem? Some folks come on in a position approaching a retirement, and they don't have a whole lot of margin. Some of the questions that were submitted earlier were like, well, at what point should I start to dial down my equity exposure? Well, if I've done a financial plan, I've had a long conversation with you, and I know the names of your kids, I know how old your kids are, I know how financially sophisticated your kids are. I know whether you want to start giving them money before you die, or maybe I suggest to you, do you want to think about gifting money before, your demise to your children and other people who matter to you, or other causes who matter to you? All that kind of stuff, they're supposed to be asking. And the financial plan really gives a basis for which proper advice can be rendered, and it needs to be updated annually to see if this is working out, if circumstances have changed for you.
So I want to make the point of the paper. I think we're going to 7:30.
Oh, really?
Yeah, I think so. Is that right, Tess?
Yeah, we can go to 7:30.
Yay.
Whoa.
Okay, people can bear with us. This is a lot.
Hopefully it's worthwhile.
I hope so. We'll see in the comments. The tomatoes being thrown. So the importance of these conversations, and that you're comfortable with the conversation, and also the importance that these conversations are documented. So again, things I'm looking at are the new account opening paperwork for those initial meetings and the account opening. And there's kind of formats that are typical for different firms that different firms use, and frustratingly limited options. So you probably will remember checking a box or having a box presented to you already checked. What's your risk tolerance? Conservative, moderate, speculative. Maybe there's a fourth option. Sometimes there's a fifth option, but usually it's 4 options. And that by itself seems like, well, okay, there's nuances, of course. Yes, absolutely. So it could seem like a throwaway that, who cares? And when I hear, oh, my advisor said, I'm picking the box speculative because that lets me access a lot of really good products for you that otherwise I wouldn't be able to. That's a red flag, because that means the compliance office is seeing that, oh, so-and-so, even though they're 80 years old and they have, assets at this level, really want to be speculative and take on lots of risk. And those automatic flag systems that are coded are going to be coded to that. And that's the first exhibit A. Well, but you signed, Mr. So-and-so, you say you wanted moderate investments now, but you signed this form that said you were willing to take on a lot of risk and be speculative. And it seems ridiculous at the time that this little stupid box could make a big difference, but it really does. So before you sign, understand those categories, err on the side of being more conservative than not, if you're really wanting to, worried about, someone going off the rails. Similarly, those forms will ask about net worth, about liquidity, how much liquidity you have, things like that. I see them overinflated constantly. And people don't remember because they're kind of guessing at the time. Well, my house is maybe worth this, but I'm not sure. or their advisor says, well, let's just put this, and that's fine. This is just paperwork. That also makes a big difference. Number one, at a certain point, you might qualify to be an accredited investor under private placement, this whole set of who can be sold certain types of illiquid private placement investments that are restricted to certain accredited investors that are supposed to be either super sophisticated or super wealthy, and equating the two, also a problem. And to be able to buy even these super risky products that, by the way, offer a 10% plus commission to the person selling it and may not be approved by the firm because it's off books. So it's my public service, I have a few public service announcements, and one is to really pay attention to that paperwork before you sign off on it. So risk tolerance, time horizons. So retirement, this is the checkup. Your time horizon is going to be very different over the years, and having your annual review, updating those forms. Your time horizon is no longer, I have 20 years to invest. Now, well, I want to start drawing, or I am drawing in the short term, the immediate term. That makes a big difference with the compliance aspect, and really also gives your professional a roadmap too. That's that check-in. Know your customer, know everything about them, and check in and update. If you have a big life event, you file for bankruptcy. Well, it's a bad example, but you got married, you got divorced, you adopted, or whatever it is, big life events that might shift your priorities and your goals. That's a good time to check in with your financial professional. Hey, I need to update this. You might also get these so-called happiness letters in the mail, which effectively are, hey, we did this thing and you've got 10 days to tell us that you don't really want to do it. Yeah.
That's new.
Or here are your selections. It says speculative and volatile and willing to do this. Tell us within 10 days if you don't like this. And number one, who opens their mail and reads their mail or their email with digital document mailings now? Just pay attention to those things, because anytime anything like that is sent to you, it's going in your file. And if something happens down the road, you do have to have, even if you have given authority for your professional to have discretion, you trust them, you do have to have a certain amount of vigilance and monitoring and awareness of what's going on. I think now maybe transitioning to what I look for, perhaps, about red flags in an account for a retiree. And you're going to make faces now and be like, I can't believe they did that. But yes, people do it. So again, research your human, look for those red flags in the human's background on broker check. And general like internet searches too. You can find stuff out about people and maybe bring into question their judgment and life priorities based on what you find online. These are real things. You find your advisor just bought a new Ferrari and is driving around, the Riviera. Well, how do they afford that? I wonder. What's going on there? But as for other generalities, are the financial account statements coming in? Do they look professional? Do they look official? Do they have the name of the clearing firm, the name of the large firm on them? Does it look funny? Does it look like it's cut and paste? This really does happen with forged account statement documentation. So does it look right? Are you getting homemade spreadsheets in lieu of account statements, and someone telling you, oh, this is easier, I can consolidate everything in one place and give it to you, and this is easier for you to read? Not a good thing. I mean, that
is a no.
That's a red
every
flag.
day of the week.
You get statements that are from lots of different companies and you don't know why exactly. And it's not necessarily a bad thing. If you have life insurance products, you're going to get statements from that company. If you're going to have an annuity, or we're going to talk about annuities in a moment, you might be getting statements from the annuity company. You might legitimately have illiquid private placement investments, LLC interest, and you're getting information from there. But if you're getting a lot of information from a lot of different places and you don't understand why, and your advisor can't explain it to you in a way that makes sense. And again, the supervisory component, if a statement's coming from this company, A, company B is not looking at it if the statement's going directly from A to the customer. So that supervisory element is missing.
Yeah, one thing you could do is just ask for samples of their statements.
Mhm.
And I've seen statements that I kind of just was stunned by, like, wow, like you said, they made it up on their own word processing software or in Excel. When you get something from a for real firm, it looks like it's from a for real firm. And if it doesn't, that's a red flag.
Yeah. So now as to the types of things in an account that I look for retirees in particular, where I'm assuming, need for stability, fixed income needs, wanting to outlive your money as a priority. That's my assumption. I mentioned lots and lots of trading activity, buys and sells, purchase and sales. That can sort of one of the metrics we use is a cost equity ratio of how much does that portfolio have to earn in order to break even for the customer. And I've seen it at 20%. So the account performance needs to be 20% just to break even from the amount of fees eating away by the broker who's generating transactions. So lots and lots of sales, lots and lots of purchases, questions to ask why. Could be legitimate, but questions to ask why.
Unlikely.
Over concentration, you have 95% of your portfolio invested in one stock type. Unless, meaning like IBM, I don't know.
Or one sector, like
or one sector.
80% in energy or 80% in information technology.
Yeah. So unless you are willing to take the risk and you understand and you talked about this and you have a preference to be all in on tech stocks and no, I don't want to hear anything else. And you've had your advisor explain to you the risks and the benefits and this, that's a problem. I've had a 90-year-old client with 95% in single stock oil and gas stocks by a broker who did the same thing for all of his customers, regardless of their age or objectives. And of course, energy market tanks, the account tanks. And it's that cookie cutter approach. That's another thing, that press the button. Those initial account paperwork have to be calibrated correctly in order for that to work. It could be a good tool for an advisor, but those account information documents need to be correct. High volatility, high risk sectors, products, single stocks, overselling of complex fixed income products, guaranteed return promises, illiquid investments, things that generate large commissions for the seller that may promise stability in scary times, like variable annuities with like income streams at some point, or certain types of fill in the blank name and then CD is after it. And it's not a bank CD, it's some kind of securities product that is leveraged and pinned to indexes and new products are developed every day by smart people to sell to you. And the worst of them are the ones that prey on fear for retirees wanting to have guaranteed fixed income, guaranteed returns. And anything that says guaranteed is a red flag to me, unless it's a, bank CD, boring old bank CD, something like that. Because that's where we see, fraudulent products, promissory notes that are supposedly secured by something to give protection. And I don't know, right now, market rates, if I see a promissory note that promises 12% returns and guaranteed, I am raising the big red flag. That is just cannot exist right now. Not a legitimate investment that is actually secured and on the up and up. More illiquid products than not. why do you need liquidity in case you need to sell?
Let me give you an example. So a buddy of mine asked me to take a look at the $1 million he's got with a small firm. And there was 200,000 and change invested with one particular provider, Business Development Corporation. It's not an unknown one. They only had access on a quarterly basis, and only if the provider said, yeah, we have enough liquidity, we can manage to get funds to you. I wasn't very comfortable with that. And then I happened to go on to Bloomberg and see that this particular company, their CEO was written up in Bloomberg as being a guy who threw staplers around the office and yelled at his people, and none of his people wanted to stick around. Morale sucked. Other people companies that would come to him, potentially their firm looking for funding, were deterred by the nature of this guy and the operation he was running. And all I could say is, I hope you can get your money out as fast as possible, because this is a sinking ship, unfortunately. And going back to the diligencing of privately placed investments, there wasn't any. Maybe one thing I just want to toss out, because I know we are getting low on time, and I think it is topical, and that is, should I expect my advisor to be changing my asset allocation or getting me out of the market? Because, Jesus, this is a pretty weird time. It is ingrained, I think, in the skins of most and DNA of most advisors that no, look at, we come upon the right, an appropriate asset allocation between fixed income and stocks and other stuff, and we stick by that. And they say that for many reasons, one of which is that's their safe haven. Because if all of a sudden they start making market timing calls, and for somebody to say to you, hey, look at, man, I am really worried about the guy in the Oval Office. I think we ought to get out. You may say yes, and that's cool. But if the individual says, I'm really worried about what's going on in the Oval Office or wherever, I'm going to change the asset allocation. Now that individual has opened himself or herself and the firm on up to a complaint. Because they are deviating from basically what you had agreed to. Having said that, it is, your right, and I would argue your responsibility, to log in with your advisor and say, you know what, I'm really worried. I've been through this car wash before in 2008 and 9, and I really prefer not to go to it again. What can we do? Then you can have a conversation that's rational and hopefully results in an appropriate resolution. I mean, it's especially in a fee-based situation, it's very easy for an advisor to say, okay, we can dial down the risk, not necessarily by changing, the percentage of equities that we're allocating to, but changing the nature of those equities. Let's get out of tech stocks. Let's get into financials, healthcare stuff, consumer staples, stuff that doesn't, blow up as readily as those kinds of lower risk companies and businesses.
There's many ways that could go. There's no one size fits all.
No, and I would say at this time it's a little bit late to make big shifts in portfolios. I mean, the damage was done, back in February and early April. But
and selling,
you ought to feel comfortable. You ought to feel comfortable with the individual in your team and saying, I'm worried.
Yeah.
What should we do?
And another reason to have a fee-based professional who is thinking about your entire financial plan holistically and may have a tax department is if you sell off, what's the tax penalty? What's the tax hit that you're going to realize immediately? If you're on fixed income and you don't have liquidity to pay the tax bill at the end of the year, that's a problem. How is this going to impact my Medicare assessment for future years if I have a hit for an increased income year? How does this impact these other pieces of my carefully designed plan that might be, interrelated? And doing this one action that's maybe out of more fear than logic in the moment is going to have that ripple effect. And the old adage of, and this is the reason why there's a term in my area called financial suicide, which is effectively, making decisions in an account that's going to kill the account because you can never recover. If you don't have a long time horizon for recovery over that long period and you sell off, you're not going to recover and be able to get the gains that an upgrade market might have. And it's really hard. Like there's studies on this that are fascinating. How rare it is for a sell-off to be beneficial for a retiree. In terms of an investment strategy, we can call it a strategy.
We're at 7:15. Do we want to kind of go to Q&A?
Yeah, I'm going to give just a quick 1 minute run through though, because this is important of things to look out for in these times. Because I see these, get calls about these. Anything gold and precious metals. Seriously, I mean, look, if you want to invest in gold and precious metals, fine, but this is not the cure-all investment strategy. Anything that comes from a YouTube video, there's a lot of advice out there. And, if I found my financial professional on YouTube, I would fire them and go somewhere else. It's really concerning, misinformation that's out there. And again, fear mongering to get, to push things. Anything market timing. Market timing is not tried and true investment. I think Morgan Stanley actually prohibits market timing as a general rule.
That's what hedge funds are for. But having said that, again, if you're the client and you say, I want out, right on. I'll try and talk you.
Yes.
I'll tell you the pros and the cons. But look at, I have a close friend who was in the business for 20 years. And in 2022, he said, you know what? Fed's starting to raise rates. I'm selling all my stuff. I'm going to T-bills. And the guy slept beautifully for a year and a half. So, being early, however, is important with those kinds of decisions rather than late, which is when our instincts, our behavioral economics tells us that we as human beings, when we freak out, is generally speaking very near the bottom of the market.
Yeah. Anything crypto, anything Bitcoin, anything real estate development, non-traded REITs are still a thing, real estate investment trusts, and promises that this real estate's going to generate income. It's so great. I've seen more than once. There's no real estate. These are things to investigate before jumping into.
Oh, you mean the ones that advertise on Sirius XM radio?
Yeah, the ones that only the trust company in South Dakota will allow you to put in your IRA because no other firm will allow you to touch that. Illiquid investments in your IRA. You have RMDs, required minimum distributions. You can't get access to cash to pay, and you can't do anything with these products. See it. So how to protect yourself? The question was asked of, how do I kind of think about my future self maybe being more susceptible to bad advice or fear, or protect myself from making bad decisions? Having a financial planner, financial advisor who is your buffer. Also, there are ways to do estate planning that might be advanced planning, putting things in trust, having someone else be trustee over a portion of your assets who can have a more level head and control, because the romance scams are out there. My fellow humans, we are susceptible to the text scams and the email scams and the fear scams. I'm going to give my last example of smart client gets a call or actually gets a phishing email to log into their streaming service account because something is flagged. So they or to call the number. So they call the number based on this email, and they get their the customer service person for the streaming service. I'll say Netflix. I don't remember what it was. Something. And this person says, "Oh yeah, I see you have 20 accounts opened in your name, and they're all linked to all different bank accounts in your name." And it scares this person. What? That's wrong. Oh my gosh. Oh, it's a scam. I'm going to link you to the fraud department. I'm going to link you to the FBI. I'm the FBI agent. I'm sending you my credentials. Here's what you need to do. Send me your information so I can start protecting your accounts because I can see online that they are being liquidated as I'm talking and the money's going overseas and you're never going to get it back. So you can only imagine in the moment, this sounds irrational, but in the moment, this person was led down the rabbit hole and happily didn't give complete information before she called me, and we got her in contact with the actual FBI and checked in and could see. We know this was a fraud, and she reported the scammers to the FTC.gov website to report financial scams. She reported to her FBI, her local law enforcement, did all the right things to document what had happened because, gosh forbid, if you are subject to a scam, document, report, potentially some very, very unlikely if money goes overseas, it'll come back. But scammers now, sometimes they'll just funnel money through US bank accounts before it goes overseas, and sometimes the FBI can find it. Not very often, but sometimes it happens. And document for a theft loss, homeowners insurance, things like that. These are all reasons why I would go back to use a registered investment advisor or a broker or someone who's both, because at the end of the day, if a human is giving you bad advice, bad recommendations, or stealing your money, there's a firm there that has responsibility for that human, and you could potentially recover against the firm. The individual on YouTube or the random emailer or texter, you won't find them. You can't get money back for you. And that's the PSA. But also good estate planning can help you protect yourself from your future self, as well as developing relationships with financial professionals. And so much of this is tax planning. I mean, that's the element we didn't get into because we're not tax people, but so much of retirement planning and these interconnected things are tax planning and working with a CPA or a big firm that has dedicated sort of services that are tax focused to understand those options. Okay, that being said,
Questions.
there's a lot. We're gonna take questions, and Tess, maybe you can help out if there have been some that we didn't quite catch on the online chat.
Absolutely. I think the majority of the ones in the online chat have been covered. Between different fees for different types of firms, as well as what you might, some of it's more specific advice. Paula has just asked if you can recommend a couple books to help with navigating minimum required distributions.
Well, I never had to do that. At a firm like I was speaking of, there is a whole department that does nothing but that. They have the software, they have the expertise. If you want to kind of spitball what you should expect, you should call your advisor at the firm and say, hey, what are your folks saying my RMD needs to be? They should be able to provide the factors to you. If you really want to get into the weeds and you don't have somebody who you trust, you can go online to the IRS, and there are life expectancy tables, which have it's not the easiest thing to figure out actually, but you can figure out what percentage of the account value you will need to take out. And Gary Prince, hi Gary, has a simple calculator there as well. But yeah, again, the big firms will do it for you. They don't trust anybody sitting in an advisor's chair to do that.
And I'll put in a pitch to not try to do too much self-help with taxes if you are not willing to take the risk of doing it wrong and not be able to unwind it. The IRS is not kind in correcting, letting you correct some mistakes. Sometimes yes, sometimes no, but you know, like making your IRA, if you inherit an IRA, making your selections, that sort of a thing. It can be very hard and expensive to unwind a bad decision when it comes to this stuff. So a CPA is worth a little bit of prevention on some of these tax issues.
But again, ask your advisor and keep asking if they're not getting it for you. I mean, literally, I couldn't answer those questions, but I had to ask them. I had to ask them of the group internally that did it, and they're never wrong.
Yeah.
So without disclosing too much personal detail, what are you doing with your investments in the current environment? Well, humility here. I run some money for family members, and I have a particular mandate, which is to keep the money relatively high and dry. I had been out at 70% equities, and I got scared, and I shrunk it down to 40, then I shrunk it down to 20. Losses kept accumulating. I shrunk it down to 10. It was down at 5. It's now at 15% equities. What did I do with the money that's with my former partner? Nothing for a very long time. Too long. And then, as I described to you, when it feels like you're throwing up in the about to throw up in the wastebasket, as the Wall Street expression goes, that's when you pick up the phone. Had I actually spoken to my partner, he probably would have said, chill. However, I said, look, strip out like 35% of the equities. Because my own concern, this is my personal concern, is in recessions, corporate earnings decline. I heard this from Steve Leisman on MSNBC. This is not me. And I regard no one more highly than Steve Leisman, who's a brilliant fellow. He said, in recessions, corporate earnings drop by about 30%, and at that time, the market had dropped by about 18%. When things get really bad, like we saw during the great financial crisis, you're looking at a 50%, as we like to say, drawdown, as instead of losses. Actually, it was, I think, 54% for the S&P from peak to trough. So if things get really bad, badder than the market certainly is discounting right now, there will be a lot more downside. And this is where we get into this is a very special time because we're not looking at a business cycle. We're not looking at mortgage-backed securities that were sort of opaque and distributed around the world. And we really didn't know where the problem was. We didn't know what financial firms harbored those toxic assets. We didn't know what was going to blow up. I mean, that was one problem. Now our problem is basically we have a great economy, or it could be a great economy. We just have a guy who wants to go completely off script. And, he could send out a tweet tomorrow morning after you've liquidated 35% of your equities, like I did. And all of a sudden the market goes, oh, he doesn't really mean it. That's what's so hard about where we're at right now. It's making a political and psychological assessment of the political dynamics in Washington, D.C. That's not what previous recessions have looked like in the United States. So I'll stop there. it's a bitch of a situation. It's no fun to be an advisor right now, because you have a history book that tells you what happens in recessions. But what we have right now is the same sort of opacity that we had with mortgage-backed securities and all this toxic asset stuff that was, all around the world. We didn't know who you could trust as a counterparty. Like, is Goldman Sachs going to go bankrupt in 3 months? That was what we were worried about back then. Now it's, well, who's going to get by tariffs? And is it going to put them out of business? Or is it going to make them run at a loss for the next 10 years? Or are they going to cut a side deal? Like the semiconductor folks seem to have done in Apple, with computers in the last, 48 hours. That's a question to have, discussion to have with your advisor and figure out, like, well, what do you suggest? And he'll say, or she'll say, what would help you sleep better? How much money do you think you need over the next 1, 2, 3 years out of this pile of dough that we need to get high and dry so that you're not freaking out?
I was going to contribute to, I am constantly working my way through worst case scenarios for my day job and advising, thinking through. And I do that for myself too. I find that gives me comfort to, if everything around me is unstable, I can't control, what can I control? I've looked at my spending, I've looked at my discretionary spending, I've tightened up the budgets, I've looked at, basically staying the course because I have a number of years of working life left, I expect. But I've also thought, if really things went pear-shaped, can I get by? Do I have an emergency fund in cash? Am I safe in my domicile? Kind of prioritizing and valuing those cost expenses and maybe pushing back the vacation, pushing back the new big purchase until things stabilize a little bit. I think too, I for myself, I look for lowest cost, broad spectrum index funds. I'm a very boring investor. And I don't personally invest in target date funds, but I look at them to see what the fancy firms are doing with the allocations of their target date funds. So like the target date retirement year 2055 says the allocation is this. And I kind of check in on that once in a while and just see what those allocations are. And if you are a self-directed person, you have your own account that you're working with, you can kind of create like your own models cheaper, based on what you're seeing on some of these other funds from reputable sources. But cutting out the noise of the fear-mongering and anything goes investing, focusing on maybe some reputable sources for research, looking at the SEC website, FINRA's website, the investor education. They really do talk about these things with reputable sources. Our network news is more about panic and fear than kind of quality information of late. So I think choosing your sources wisely, and planning for the short term, talking to people, talking to your community. My final PSA is, be kind to yourself and each other during these times. And if you have made some decisions that are a little radical that you're regretting, work with a professional or rethink and rebalance.
Yes, somebody put up the screen, I think I know it is. I don't know what's going to happen. So I have an asset allocation, which is rebalanced on the way up, which I take it to mean you peeled off some equity and put in fixed income. And now it's well above target. But you've got about 3 years of liquidity and I forget what the 5-year part was. And I think that, I think that's great. I'll never forget Jim Cramer, as crazy as people think he was, in 2000 said, 7, he said, look at the Fed, they have no idea what they're doing, no idea. I urge you to take 25% in your retirement accounts, put it in cash, because these people do not know what they're doing. That was good advice.
I would love.
Early advice. But again, you want to be able to sleep at night, and most people want to feel like they did something. I mean, I get that. And that's why, I pray that you have an advisor or some people you feel comfortable talking to who you can shoot straight from the, reasoned from the hip with experience and help you sort that on out. Because generally speaking, if you know you don't need to touch the dough for 5 years or whatever it may be, the political cycle will probably take care of our current problem. There may be other problems, but the one great thing about owning stocks is that they're a levered way to own the economy that we live in. This economy, if you look back 100 years, we were driving Model Ts and the telephone, had a wire attached to it. The future is very bright. It's just stupid policy errors that stand in our way, I think, today, which makes it so difficult.
I'm going to make a plug for a book.
Yeah.
I brought it. This gives me reassurance. It's reverse, I think. A Random Walk Down Wall Street. This is a publication. It's been out a long time. There's been the most recent edition is 2022, I think, or maybe even more recent. This is enough of the history of investing in the U.S., the market, how things work, ups and downs. It's gets technical at points, but it's not too technical. And I'm rereading this again for reassurances. The author is Burton G. Malkiel, Malkiel, A Random Walk Down Wall Street. And if you look for that, you'll probably get pop-ups for other similar type books. But
there's one other really good question that came up. If I'm a high earner, should I avoid contributing to a Roth or not? Let me just touch on that real briefly. When I left the business, what we were talking about is that Roth IRAs give you an opportunity to hedge against different tax strategies in the future. So if you think that taxes are likely to go up on somebody in your expected tax bracket, then by all means, you would be well advised to shove some money on into a Roth so that when you're paying taxes at today's rate, and when you withdraw it and it's in a higher tax environment, you made up a bit. The other thing about Roth IRAs that's kind of cool is if you've got some dogs in your portfolio or things that kind of went busted, like, I don't know, you had some Lehman Brothers structured investment products, like I did. If you shove those into a Roth and they have a very low cost basis, as a result, not cost basis, they're valued very low when they go into the Roth. Or you have a zero coupon treasury or a zero coupon municipal bond, and you expect it to accrete naturally over time. Those are really great things to tuck on into an IRA because they go in valued at 10 cents on the dollar, and some of them are going to be worth 100 cents on the dollar, and some may be worth 22 cents on the dollar. This was the case with Lehman Brothers. So just a couple of thoughts about Roths.
I have a comment. Can I make it?
I'm going to do our closing real quick, and then I will open you all up to continue talking. But I want to make sure that folks who are still hanging on hear that, just in case other people want to sign off since we are over time. But thank you both, Tony and Darlene, so much for sharing your expertise. And it's somewhat reassuring as a young buck to hear that even those of you who are a little more experienced and have seen some more of this are feeling somewhat hopeful, even if concerned. It's good to hear. For those of you who attended, thank you so much for being here tonight. I will be sending out a survey tomorrow so that you can tell us what you think. I will also include all of my notes from this talk, which includes many of those acronyms that came out pretty quickly. So if you weren't taking notes at warp speed, know that I have some of those, as well as the handy links and Darlene's book recommendation. If this is the kind of topic that you're really interested in, know that there will be future events in the When Reedies Retire cycle hosted by the Foster Schultz Club. The next one is going to be Don Asher at Reunions, talking about the transition to retirement with his retirement boon or trap talk. That'll likely be virtual as well as in person if you can come and join us. So thank you so much, and I return the floor to those of you who are still here, and you can feel free to keep talking.